Lowe's just dropped its third quarter earnings, and in what's been a pretty tough market, the stock just took off. So we're going to break down what exactly lit that fire, what it tells us about their big picture strategy, and of course, what it all means for the stock from here.
Okay, here's the game plan for today. We'll kick things off with a quick snapshot of the numbers. Then, we'll dive into the two big engines that are really driving this thing, their pro customers and their digital sales. After that, we'll look at their guidance and a massive acquisition they're making, check out how the market took the news, and then wrap it all up with our own rating on the stock.
So the first thing you need to know is how Wall Street voted, and they voted with their wallets. The stock shot up a solid 4% right after the announcement. Investors clearly loved what they heard, so let's get into exactly what that was. All right, first up, let's talk results. This quarter was all about winning the battles that mattered most. Now, this is where it gets interesting, because you're looking at a split decision here. On one hand, they delivered a really solid 3% beat on adjusted earnings per share. That's the bottom line, and that's great. But on the other hand, they came in just a hair shy of what analysts expected for revenue. This tells a story right away. Lowe's is doing an excellent job managing its costs and protecting profits, even if the top-line sales were a little soft. And this slide really lays out the whole story of the quarter, doesn't it? The good stuff was really good. Strong earnings, their profit margins actually got a little wider, and online growth was just fantastic. All that strength was more than enough for investors to look right past that tiny revenue miss and the dip in the number of people coming through the doors. So if profitability was the big win, what exactly was pushing it forward? Well, the answer is crystal clear. It's all about their professional customers and their booming digital business. And this number right here, wow, it really stands out. Online sales grew a massive 11.4%. You have to remember, this is happening at a time when shoppers are being really careful with their money. So for Lowe's to be capturing that much business online, that's huge. And this growth wasn't just random. It was laser focused on their most valuable areas. They're grabbing more business from professional contractors. They saw double-digit growth in home installation services. And get this, it was their fourth straight quarter of growth in appliances. They are absolutely winning where it counts. Okay, so that's the quarter that was. But what about what's next? This is where we get into their guidance and a really big strategic move that could seriously reshape their entire business. So if you look at their forecast for the full year, they're actually bumping up their sales target to about $86 billion. Now, that's mostly because of a new acquisition we'll talk about in a second, and this is a key but, they also slightly tightened their earnings forecast, which is a signal that the investments they're making right now will weigh on profits just a little bit in the short term. Looking even further out into 2026, management's tone was, let's say, cautiously optimistic. They're basically making a bet that as interest rates eventually start to come down, all the strategic moves they're making right now will really start to pay off and accelerate their sales growth. And this right here, this is the centerpiece of their whole strategy going forward. It's a massive, nearly $9 billion acquisition of a company called Foundation Building Materials. This is a huge pivot to go after a much bigger piece of the professional contractor market. We're talking drywall, steel studs, the heavy-duty stuff. They're telling the market they are more than willing to take a small short-term hit to their margins in exchange for what they see as a giant long-term growth opportunity. So that brings up a really important question. Why did the market get so excited about a report that was, a little mixed? Well, to understand that, you have to look at the context. It's all about what was happening before the announcement. And this chart tells you everything you need to know. For the past year, Lowe's stock was down almost 12%, while the broader market was up over 13%. The stock was basically in the doghouse. Expectations were on the floor. And that set the stage for a huge relief rally on any news that wasn't a total disaster. And investors didn't just nibble at the stock, they stampeded into it. Trading volume on the day of the report was 2.7 times the daily average. That's a clear signal of conviction. That's the big institutional money stepping in and saying, okay, we're buying this story. So let's put it all together. You've got solid execution, you've got a bold news strategy, and you've got a market that was just starving for some good news. So what's our call? Where does Lowe's go from here? This really brings us to the big question for anyone looking at this stock. Was this just a one-day wonder, a flash in the pan because expectations were so low? Or is this the beginning of a real sustainable turnaround? We think the bull case here is actually pretty compelling.
I mean, think about it. They're gaining ground with that super valuable pro customer. This new acquisition creates a whole new engine for growth, and management is showing they can really control costs. After a year of underperformance, it feels like a lot of the bad news is already baked into the price.
And because of all that, we are initiating our rating on Lowe's as outperform with a 12-month price target of $270. We see a clear path for the company to execute on its strategy, which should create significant value for shareholders, especially as the housing market eventually finds its footing again. This is not financial advice.